Welcome to the Financial Modeling Teacher. In this video, we discuss asset price returns and their statistical properties, also termed the stylized facts. Or in essence, this discussion is about real-world asset price behavior. The asset price is a reflection of the underlying value of traded assets. These are influenced by fundamental factors such as earnings, growth potential, and economic conditions. Accurate modeling helps in assessing whether prices are fair or deviating from their intrinsic value. So what do you mean by intrinsic value? It represents the value of an asset as calculated through various valuation methods that consider the asset's future cash flows, earnings, and other fundamental metrics. Fair value represents the price at which an asset would be exchanged between knowledgeable, willing parties in an arm's length transaction. It is more a market-oriented concept and can be influenced by current market conditions and other factors. About modeling, why modeling the assets? Realistic models consider multiple assets and various factors that influence those markets, such as the different sectors reacting differently to economic changes, affecting asset prices and portfolio performance, overall market conditions and economic indicators having an impact on asset prices across sectors, interest rates, inflation, and other macroeconomic variables significantly influencing the asset price movements. So models distinguish between fair value, which is the intrinsic value based on fundamentals, and market value, that is the current trading price. So identifying discrepancies between these values is crucial for investment decisions and risk management. The purpose is not to predict future prices, however. Rather, we are more interested in the behavior of these asset prices, which is termed the stochastic behavior of these prices. In other words, the time dependent or changes to this variable over time, which can be reflected in the returns behavior of these assets. Returns have a great stochastic component described in various models. For instance, the evolution of stock price process itself, which is represented by the stochastic differential equation, which we will discuss at a later stage. In equity portfolio management, understanding asset prices involves more than just their absolute values. A primary interest often lies in the relative return of assets and their variations over time, both captured well in the characteristics of price data. Continue to asset price characteristics, we say directly observable and reliable and available from various markets. Interest is, however, on details and statistical summary derived from the data. So commonly, we are interested in the first order measure in the change in prices over time. And the second order measure is the measure of variation. As we have in the previous module discussed the first measure, which would be something like the log return, which we have calculated to be a log of price t over price t minus 1. Then the second measure will obviously be something called standard deviation, or then volatility, if we've covered it in terms of the trading times. So these returns are obviously, we've covered the log returns as a measure of return that is popularly used. So these, as we've already seen here, are scaled in a simple way to correspond to annual rate depending on the length of the time interval of interest. For instance, weekly interest rates, daily share prices, or even monthly commodity prices, or any of, depending on whichever asset and how frequent is it traded, or how frequent we are interested in analyzing the behavior. Now, as time interval becomes shorter, the behavior of returns changes in a significant way. The standard deviation of log returns, called volatility or annualized standard deviation, is one of the factors. One derived measure of observable data can be used in place of a standard deviation. That is a statistical volatility or realized volatility. That is a simple standard deviation of measured log returns over a sample of intervals. For instance, we might have just, instead of the whole population standard deviation, we might just talking about a sample standard deviation, which is measured within a short period of time, where we have x minus x as our period divided by number of terms. So that now the realized variance could then be just that period given about a sample of, well, let's say, few items, just to calculate or work out exactly the realized variance. Now let's come to the behavior of the actual returns themselves. We extracted the S&P 500 for a long period of since 2005 to 2024. The reason for such a long time horizon being the fact that we know that the longer the data, the more time business cycles it might have overcome, let's say many recessions or other structural economic breaks. As a result, now to really find the perfect description of the behavior of data, the longer the time series, the better. So this plot here is for the S&P 500 log returns. Theoretically, we expect there to be symmetry. In other words, we expect something like this, which would then be somewhat a normal distribution. As you can see, a normal distribution is anything with the mean of 0 and a variance of 1. Theoretically, this is what we expect. But we can already note that between just this part, there's already a gap, whereas in this part, there's a slight overlap to this side. Immediately, we can see that definitely, whereas we are expecting there to be a symmetry, or in other words, we are expecting this part to be equal to this part exactly, and also that part to be exactly the same as that part. But this is not a true picture. Right, let's go ahead and now from the previous histogram, we can make conclusions that the assumption of normality or Gaussian distribution about the log return may not be accurate, despite that the theoretical normal distribution accommodates symmetry and unimodal distribution. Log returns may not reflect a true normal distribution and symmetrical histogram. So the QQ plot is the next plot which confirms this non-normality. Which follows in this plot, as we can see here, we have this plot, if it was a straight line, normally they plot about a 45-degree angle, so that now this blue sitting on top of this plot exactly could be a better fit theoretically of a normal distribution. Even if it is like this, we can tell that this part up to here corresponds to that part up to there. So meaning that between 0.05 up to 0.5, there might be normality. But immediately as we go on, we already experience outliers. Look at us there, there's already outliers. But from the look of things, looking at that far outlier dot, which is exceptionally way below the -10, whereas on the other side, there is something just on top of 0.10, just on top of the 10%, but compared to the far negative, which is way below the -10%. It's another reflection of non-normal distribution, because in essence, we wouldn't expect those much of outliers if the distribution was perfectly a normal. This plot is for the actual log returns themselves. But once again, they confirm, look at that outlier again, it's way below, which is a depiction of what we had earlier on in the previous QQ plot. Against that one there, which is not as far as this one though. Then we also have that one outlier that's slightly below 10%. But apart from that, this plot also shows us something here. It exhibits something where this movement goes higher, it goes even higher. Then from that we followed by some large drops, followed by even lower. And the same thing happens again. They go higher and then even higher and then lower, even lower. So that behavior is called volatility clustering. The overall picture is that this outlier, which is just around -20%, corresponds to that observation or even determines the fat tail to the negative, which also carries the negative skewness aspect, corresponding to the outlier in the form of a very low observation, which is also an outlier from one of the periods. This confirms all the stylized facts talking to each other. We can say we have a negative to a negative determined by that negative to give us that picture of our stylized facts or these statistical properties. So this also defines kurtosis. Kurtosis as a measure of these fat tails. But now it also defines skewness itself. Now the skewness in the sense that it may not necessarily be symmetrical, but now what it really means here that it actually confirms the large moves that are frequent, either positive or negative. So in essence, the positive skew, it's large movements frequently happening as compared to a negative skewness where a large frequency of returns being negative. So we've seen the time series plot of a daily S&P, and then we've also noted as few points with very large absolute value returns relative to the data. And we've also seen that large values are followed by large values and vice versa, larger values large values followed by larger values, and vice versa. Now, this brings us to a conclusion that empirically, this behavior has been exhibited by the data through most studies, and the gentleman by the name of Ramakont formalized this behavior in his paper by terming them the stylized facts of asset returns. The first one being the heavy tails, which means that extreme returns, both large gains and larger losses, occur more frequently than one would expect under a normal distribution assumption. Then there's no symmetry, so meaning that there's asymmetry. So the skewness measure of the symmetry of the return distribution around its mean. Then this could mean this skewness could either be positive or negative. So the distribution has longer or fatter tail, right tail. This means that there are more frequent or larger positive returns compared to negative returns of the same magnitude. The negative skewness, on the other hand, the distribution has longer or fatter left tail. This indicates that there are more frequent or larger negative returns compared to positive returns of the same magnitude. For instance, it is well known that the S&P 500 exhibits a negative skew, confirming this, and this has been formalized as a stylized fact. For those of you who are interested in active passive portfolios, it is worth noting this stylized fact. Continuing, the non-constant volatility or the time-varying volatility, also known as stochastic volatility. It refers to this phenomena where the volatility of asset returns is not consistent over time. Instead, volatility changes in response to market conditions, economic events, or other factors. And this feature is a critical aspect of financial markets and an important implication for risk management, forecasting, and portfolio optimization. For instance, the time variation also touches on the issue of leverage effect, as we are aware that trading and asset acquisitions are associated with loans. So in this case, when there's an increase in return volatility itself versus a negative returns, so it means instead of returns going high, we have instead the volatility going. This has a bad impact on the assets itself because the balance sheet will immediately suffer a leverage effect because now it's a matter of the debt going higher than equity itself. So yes, we further continue by saying the volatility clustering refers to the observed phenomenon where periods of high volatility tend to be followed by more high volatility, and periods of low volatility tend to follow low volatility. This characteristic is a critical feature for financial market and has significant impact on the modeling, risk management, and other investment strategy. Now let's introduce a simple model that we do not even characterize with anything. But let's just say we look at a stochastic process. The term stochastic is nothing else but time varying. It captures those variables in an asset price which are subject to time variation. So in this case, suppose we introduce a simple model where this mu here could be nothing else but that just the mean of expected of returns. So if you sum up you work out a return for, let's say, 5-year daily data, and we side note their mean, our overall average is the mu there, and we are interested in just estimating these return based on just mu itself. In other words, from the average, a constant average which was estimated using a 5-year data, we are interested in estimating for a particular period the xt, which is a random variable for returns at this stage. It's just a random variable for returns, and the only information that we have is u there. But we know that model has got a shock, or this so-called white noise process, which is reflected in the fluctuations as well as the shocks in the system. So now the summation sign here is showing that we're going to have a counting of depending on the length of the period here, even though here it's a general form of saying up to infinity, but it could be up to 5 years, up to many other years. But what's more important here is that an average that is constant, and also with the term deterministic. The constant deterministic, meaning that it is constant, it doesn't reflect any time variation. Then plus whatever shock we might have. Then we have there A, which is a little coefficient. We will make some discussion about this as we go along, but we want to keep it as it is now. So now this model, a simple model, also has something called stationarity, which is something that we assume to remain constant over time. Now, we fitted that same model, but in this case, we made our A to be something like 0.01, just arbitrarily. And we fitted that model over a certain period, and then we end up with this plot. The red plot being the model itself. However, measured in this exact with the data observed over our period of 2005 up to 2024, we've got the blue line representing the observed returns on the actual data. But now the challenge is to say, in order for us to see that our model is working perfectly, we now need the exact value of A. So in the concept that we will introduce as we go along, which is called calibration, we will then see the role of such things like techniques such as maximum likelihood estimation, which will give us exactly the value of the coefficient A, which will equate the two plots, so that the object is to have the blue plot sitting right on top of the red plot. Now this brings us to the conclusion of this discussion, and next time we discuss the Arch model and its family of Gauge models. For those of you who are interested in this presentation or some Excel worksheet or even a Python code, please email us on thefinancialmodelingteacher@gmail.com. Thank you. I hope you enjoyed this video with us. I am the financial modeling teacher. Thank you.